The Small Business Administration (SBA) guarantees loans for small business owners through its network of partner lenders. There are several SBA loan programs you might consider when you need working capital, with the 7-A program being one of the most popular. The SBA 7-A program doesn't require collateral for loans of up to $25,000, which is helpful if you only need to borrow a smaller amount of money. 1. For loans greater than $350,000, the SBA requires lenders to collateralize loans to the maximum extent possible, up to the loan amount. If you don't have sufficient business assets to fully secure the loan, lenders can use personal real estate you own as collateral. Still, not having any collateral at all isn't a barrier to getting a 7-A loan if you meet the other requirements. 1. SBA Disaster Loans. In addition to 7-A loans, the SBA offers disaster relief loans for businesses that experience losses associated with natural disasters as well as economic crises. So, for example, a business that's experienced losses due to a government mandate to shut down could apply for an economic injury loan. Similar to 7-A loans, disaster loans under $25,000 don't require collateral. If you're borrowing more than that amount, collateral is expected, but, again, the SBA won't deny you for a loan based on lack of collateral alone. 2. If you're applying for an SBA loan to purchase equipment, you may be expected to offer up to 10% of the purchase price in cash as a down payment. Online and alternative small business loans. Online and alternative lenders can offer a variety of loans without collateral requirements to help you meet your business working capital needs. The types of financing you may be able to get without having to provide collateral up front include term loan invoice financing, also known as accounts receivable financing, inventory financing, merchant cash advance, equipment financing, purchase order financing, line of credit. With these types of small business financing, there may be some type of security required, but it isn't cash or another physical asset you have to offer. For example, with invoice financing, you're leveraging your outstanding invoices to borrow money. With a merchant cash advance, you're borrowing against the value of your future credit card receipts. And in the case of equipment financing, the equipment you're buying or leasing serves as collateral for the loan. Peer-to-peer lending is another option for small business financing that doesn't require collateral. Peer-to-peer lending platforms connect investors with small business owners who need loans. Investors pool money together to fund the loan, and owners pay it back the same as any other loan, with interest. These loans are unsecured, meaning there's no collateral needed. 2. Review your business financials to determine whether you qualify. Some types of no-collateral small business financing may be more difficult to qualify for than others. With an SBA 7-A loan, for instance, you must have at least 2 years of operating history under your belt, meet the SBA's definition of an eligible small business, and have the minimum credit score and revenues SBA lenders look for. The SBA also requires that you exhaust all other borrowing options first before applying for a 7-A loan. 3. With online and alternative lenders, on the other hand, the requirements may be more fluid. For example, a lower credit score may not be an obstacle to getting a merchant cash advance or invoice financing. And it may be easier to get startup loans from online or alternative lenders that only require 6 months of operating history. The second step in getting a business loan with no collateral requirements is evaluating your business and its overall financial position. That means doing things like checking your personal and business credit scores, updating your balance sheet, creating key financial documents, such as a profit and loss statement and a cash flow statement, reviewing your business expenses and overall cash flow. The purpose is twofold: to determine your creditworthiness for a loan and to assess your ability to pay it back. Failing to repay a loan can damage your credit score, making it more difficult to obtain any type of financing in the future.